law firms are just another business. Like any professional services firm, they sell solutions to their clients. Their main input cost is the labour cost of their fee earners that they employ, both solicitors and legal support people, and they produce work in progress, bill it to clients, collect the cash, and both of those things have a major impact on being profit and cash flow. Both of those things have then a major impact on how a firm is valued. So just like any other professional firm, just like any other business that exists in the world, the fundamental valuation formula is always looking at what the EBITDA is after principal salary. So EBITDA, again, I'm an accountant first and foremost, so I live and breathe by the numbers. EBITDA is earnings before interest, tax, depreciation, and amortization, but after principal salary. So often, what happens in firms is principals don't draw a salary. They may get paid a salary, but they may not. They might just take out drawings. But in any valuation, you've got to look at, well, what is the profitability of that business after there's a commercial salary taken into consideration for the work that a principal does in operating that business, generating revenue, and so on. So the first component of any valuation formula is to look at what is that EBITDA after principal salaries. And when you value a business, you normalise that. So you take out things that are unique to the business that aren't normal operating income or expenses. For example, you might have motor vehicle expenses in there, or you might have other expenses that are unique to those principals that if you were to acquire a business wouldn't necessarily be there. So you normalise and work out what that EBITDA is after principal salaries. Sometimes that's referred to, or often that's referred to as future maintainable earnings. So you get that profit number and then you multiply it by an earnings multiple. And an earnings multiple is basically driven by the risk that's associated in that business. So earnings multiples are basically saying how many times that level of profit are we willing to pay to purchase a business. So the business value is determined as the result of what the profit is that a purchaser would be likely to earn and how much risk they're willing to take to generate that level of profit. So the two components you've got to be focusing on are what's the profitability, what's the earning multiple. So then with that business value, you split that up into two different components. And those components are business value, take out what the business assets are. Now, generally in a professional services firm and specifically in a law firm, the main assets that exist that are business assets are their WIP, their debtors, unbilled disbursements, minus any of your operating liabilities, so BAS, PAYG withholding amounts, super that you've got to pay, GST, those type of things, your normal creditors. So if you look at what the business value is, and that says this is what the value is for the business in total, take out those tangible net business assets, what you're left with is a balancing figure for goodwill. So goodwill really is just the difference between what the business is worth and what those business assets are. So if you think about that from a variable point of view, your business assets are relatively fixed. They're going to be at a point in time. How much WIP do we have? How much debtors do we have? What might our fixed assets be? Usually within firms, that's not great. It might be a fit out, but generally it'll just be your computers and desks and those sort of things, and often written down to a reasonably low value, minus those creditors and liabilities that relate to the operating activities of the business. So they're generally affixed at a point in time. So your goodwill is the balancing figure. It's the figure that will go up and down depending on what level of business assets you've got and what that business value is. So we're going to be focusing today looking at what things can you be doing to increase that gap between what the business value is worth and what the business assets are, because the higher the business value, the lower the business assets, the greater goodwill component you have in valuing the business. And goodwill is basically that intangible amount that a purchaser is willing to pay to generate that continuing revenue being, that continuing profit being made each year. So just remember that as we work through some of these next steps. So what drives value? So firstly, increased profit. Going back here, let's get right back here. If we go back into our valuation, EBITDA after principal salaries, that basically is your profit. So as a starting point, what we need to be focusing on is how we increase profit. The higher the profit, your EBITDA after partners, principal salaries, the higher the profit, the higher the baseline of valuation. Then we need to focus on reducing risk, because the lower the risk, the more someone is willing to pay for. So reducing risk is then coming from a purchaser's point of view. What's the likelihood of that EBITDA after principals, salaries and net cash recurring each year? So if I buy this business, how reliant on the business is it for that principal generating, or those principals generating that revenue? Are there systems and processes in the business that enable the business to operate without the principal being there? You know, how much cash do we have locked up in our WIP and debtors? So how much do we have to invest in our business assets so that we can actually generate that profitability? Or if we don't need to carry a great deal of business assets because we bill our WIP and we collect our debtors fast so that our cash flow is really good. How does that impact on our attitude towards risk? So that's what we've got to be focusing on. We've got to be focusing on how do we increase profit and how do we reduce our risk. So just a bit of guidance here on earnings multiples. So again, remembering that earnings multiples are the attitude of the purchaser, towards risk, and that risk being the likelihood of that EBITDA and net cash recurring. How likely is that to happen? So if I was valuing a firm, if there is high risk, meaning that, look, it's very reliant on that principal, or those principals continuing to be operating the business. They've got a high percentage of the revenue is generated from their direct work. It's totally up to them and their networks that they personally have to bring new files in, we carry a heap of debtors and our WIP management's poor, and our clients are ordinary payers. That's high risk. So what that's going to mean is your multiplier, your earnings multiple, is going to be lower, and that might be a 1 to 2 times multiple. So if you think about it from a valuation point of view, you might have a really good profit, but even if you've got a really good profit that sits there, but the risk of that profit returning is very low, meaning that it's a high risk business, then you're not going to pay as much for it compared to, say, a medium risk business, which is pretty much a rule of thumb 3 times, where there is less reliance on the principals. There's reasonable profitability expectation of that returning. Cash is managed reasonably well. And then again, if you've got a lower risk, it's going to be like 3.5 plus times earnings multiple. That is where there is very low reliance on the principal for the continuous profitability of the business. Cash is managed really tightly, good cash flow coming into the business, low risk, low of bad debts, all of those things. So again, when you're looking at it and you're looking at valuing, you got to say, well, what's the profitability, and then how likely, and the cash flow, how likely is that to recur, and for what sort of period of time is it likely to recur, and is that the lower the risk of that not happening, the higher the value. So that's just a little bit of background here, really, around earnings multiples, profitability, general valuation methodology that you'd use in looking at what a business or what a law firm is worth. So if we break that down and think about, well, what are the things that we need to be focusing on in the business to drive improvements in that value? So the first thing is we've got to drive a focus on profit. And the high, as I said earlier, the higher the profit, the bigger the base that's being used for calculating value. So if you want to get a little bit more detail on sort of profit, there's some previous webinars that you'll be able to access on a website that look at average rate, which I'll go into in a bit more detail in a moment. But we've got a whole bunch of other information in those webinars that will show you sort of some of the things you can do to drive a better profitability. But it also explains in detail the relationship between revenue and your direct labour costs, because that really is the driver of profitability in a firm. Overheads are relatively structured and fixed within most firms, but what they're not generating is they're not generating enough revenue out of the direct labour costs they're employing. That is, with their principal solicitors, with their employed solicitors, with their legal support team. And so systems and processes that need to be put in place around that relationship between how much revenue is being generated out of it has a direct impact on the level of profitability. So that's the first thing. If you want to drive improvements, we've got to get improvement in profitability. You've got to focus on the revenue that's being generated out of your direct labour cost. Second thing is cash flow. So again, if we're wanting to reduce our business assets and get more predictability around our cash flow to minimise risk, then what we've got to do is we've got to shorten that period of time between when a costs agreement is signed and that final cash is collected on the matter, on that file. So again, looking at previous webinars on cash flow, we call that the cash gap. So the more regularly you're billing, the shorter that period of time between when you start the work and when you finally get the cash in, the shorter that period of time is going to reduce the risk in the business around its turning its profitability into cash. So they're the two areas we need to focus on. Basically, when you're looking at the business and we want to drive improvements in value, you've got to be looking at this relationship between your revenue and direct labour costs, because that's where the answer is around profit for law firms. And what I see in firms is that that relationship is not focused on. And then cash flow. What are our systems around getting what we've got in WIP, build out a WIP, and then collect it and in the bank account? What are our systems to shorten that cash gap? So that's what we're going to. They're really the two numbers that we need to be focusing on, and those numbers are, first of all, average rate, which is our profit measure, and secondly, our revenue lockup percentage, which is our cash flow measure. So again, if we're focusing on these two KPIs, and we can implement strategies that drive changes and improvement in these KPIs, we're going to get higher profitability and we're going to get better cash flow. So let's deep dive into them briefly. As I mentioned, I've done separate webinars on both of these KPIs, which go into this in a lot more detail. So if you can't find them, drop us an email. I'll have my email at the end of the webinar. Drop me an email. We can send you a link to those webinars if you'd like to watch them. But I go into a lot more detail about strategies you can implement in your firm around driving improvements in both of them. So let's look at average rate. So average rate's calculated as your revenue divided by your direct labour paid hours. Okay, so this measures the actual amount of revenue earned for every hour of direct labour cost paid to earn that revenue, whether at work or not. Okay, so most firms don't really understand what their average rate is. And if you think, in a nutshell, if you think about what your labour cost is, your labour cost is what you pay for your people, regardless of whether they're at work or not, because you pay for their public holidays, you pay them for sick leave, you pay them for annual leave, you pay them for long service leave, you pay them if they're at work but they're not charging any time on client matters. So that's our baseline. And when you look at what that direct labour cost is, that direct labour cost is the total cost of all of the people who work on files in the business: equity principals, employed solicitors, legal support people. They're your paralegals, legal secretaries. So excluding practice managers, excluding receptionists, excluding finance, admin people. And so if you think about it, you think about, well, this is the total number of hours that we're physically paying people. What's the revenue that we need to make per hour so that we make our gross profit to be able to cover our overheads and produce our net profit? So if you're focusing on average rate, you've got to be focusing on what are the strategies that we need to do to improve that average rate so that we're generating more revenue per every hour that we're paying. Often a strategy of firms is just to throw more labour at it, which isn't the answer. The answer is to get your structures and your systems right within your business so that you're generating the maximum amount of average rate that you can out of the work that you're already doing with clients. Because an increase in your average rate will drive more EBITDA after principal salaries. And if you're doing that, you're improving your baseline. So I've got some, for those of you who've participated in the webinars in the past, I've got some calculations and examples of that I'll show you shortly in our two numbers calculator that I use for assessing profitability of firms. So I'll put that up on the screen shortly. The second component is then your revenue lockup percentage. So your revenue lockup percentage is really looking at what is our amount of revenue that we've generated, but we haven't yet turned into cash. So revenue lockup is your total amount of your debtors plus your WIP. So debtors being what you billed already, but hasn't turned into cash. WIP is where you've done the work, but you haven't billed it yet. So we haven't even been able to get it collected. So it's your revenue lockup divided by your revenue, multiplied by 100, so you get a percent. So the higher the amount of debtors and WIP that you have as a percentage of your revenue means you've got all of this cash that's locked up there that isn't landing in your bank account. So that's what it measures. It measures that percentage of your annual revenue not yet in cash. And if you can focus on strategies to drive a reduction in that lockup, it increases cash flow and then therefore reduces business risk. So if you've got revenue that's static, but you've got your debtors and WIP, your lockup is growing, then that's risky because you're going to have tight cash flow pressure in the business. Whereas if your cash flow is good and that number's coming down, it means that the business systems are operating more effectively and the likelihood of that profitability being generated and turned into cash improves, therefore reducing business risk. So what we've got to focus on is we've got to focus on these two key numbers, average rate and revenue lockup. So this is what you want to see. You want to see an increasing average rate. If you get your average rate going up, then you got more profit. And you also want to see a reducing revenue lockup percentage because then you've got more cash. So if you're doing those two things, you're seeing an increase in average rate and you're seeing a reduction in your revenue lockup percentage, then what you're going to be getting is an improvement in business value because you've got more cash. And that's real cash. Real cash drives less business risk, higher profitability, drives your valuation. Two components: future maintainable earnings, profitability, EBITDA after principal salaries, earnings multiple, the lower the business risk, the better, the higher the earnings multiple. Okay, so let's take a look at some numbers now. Okay, so for those of you who have participated in our last few webinars, these numbers will make sense to you. If you haven't, then there's a whole bunch of numbers that land behind these that drive the profitability of and the cash flow in a business. But fundamentally, the profitability of a business is generated here by the average rate, and that's calculated by looking at how many hours are paid in that business, how much of that is actually included in WIP at what charge rate, and then how much of it's billed produces the fees billed. So if you think about your normal formula for what goes into a fee, whether or not it's a fixed fee or otherwise, it's basically number of hours times the charge rate times the recovery rate. So how much of that time that's gone into WIP has actually billed, that produces your revenue. So what you've got to be focusing on in your business to drive improvements in your average rate, those are the activities that drive those two other KPIs that drive the output of average rate improvement, which are productivity and your write-off. So improving productivity being more time when people are actually at work and available to work, more of that time landing into WIP. So productivity is just a formula of how many hours charged into WIP or expected to be charged into WIP, 5, 5.5, 6, 6.5 per day, divided by the number of days that or the hours that somebody is at work. So if someone does, they're at work for 7.5 hours in a day and their expectation is 5 hours a day, then their productivity is effectively 2/3 or 66, 67%. So focusing on getting more time into WIP at the right rate, and then when it goes into WIP, it gets billed. So again, going back into previous webinars, you'll be able to get some more detail on that. Your write-offs are basically then how much of that WIP that's actually gone in there lands in a bill. So for example, if you've got, let's say there's $10,000 of time that has gone into WIP on a particular matter, but there's only $9,000 that's been billed, so that will then have a write-off of 10%. So what you've got to do is you've got to first of all get as much money into WIP as you can, or dollars in time into WIP, and then you've got to make sure it gets built. So focusing then on the underlying systems and processes that produce positive improvements in productivity, positive improvements in reduction in write-off, produce increases in average rate. But what you've got to do is you've got to go back to your business systems and say, what are the systems that we've currently got that are causing that to not be the case, and change them so you get a different outcome. So let's have a look at valuation to start with, because so we can put some numbers to what I was just running through earlier. So in this case here, we've got a business that's generating fees billed of $1.8 million with an average rate of $131,000. They've got $600,000 in working capital assets, and so they've got a revenue lockup percentage of 33%. So in this particular example, this firm's got revenue of $1.81 million. Their direct labour costs, so that's the cost of all of their fee earners, excluding principal salaries, of $760,000. Gives a gross profit of $1.05 million. Take out your admin labour, take out your overheads, so that their EBITDA before principal, sorry, that should be EBITDA before principal salaries, is $637,000. So the first thing that we've got to do is we've got to have a look at what that profitability is after principal salaries to determine what the value of the company is. So in this case, let's say it's $175,000 per principal, and say there's 2 principals in the firm. That gives us an EBITDA, again, sorry, it should be EBITDA, but that gives us an EBIT there of $287,346. So the baseline profit that we're going to be focusing on, that we're going to be using to calculate our business value, remember it's profit times earnings multiple gives us value, is that 287. Now let's say there's just a medium risk in this business and that value and that earnings multiple therefore is 3. So what that does, if you take through those calculations that I went through previously, is you take 287,000, multiply it by 3, and then that gives us a business value. So the value of the business is $862,000. And that includes all of the assets of the business assets of the business, and being tangible, and then the intangible assets being goodwill. So goodwill here is just our balancing figure. It's we've got our net business assets are our working capital assets of $600,000. There's another hidden amount of lockup over here that shows WIP and debtors totaling 600. And our creditors are 98,000. So the net balance means that after you take away the net working capital assets from the business value, your final balance is goodwill. So what we then need to have a look at is if we focus on strategies that improve our profitability and improve our working capital assets and reduction in that. So remember, driving average rate up, reducing our risk by having better cash flow, meaning improving reducing our lockup percentage, revenue lockup percentage. Let's have a look at what sort of impact that will have on our goodwill value. So 1, our business value, and 2, our goodwill value. Okay, so let's say that in this particular firm where we've got a starting point, their productivity is only running at 39%. Okay, so there's no difference here between our targets. We've still got 13,832 paid hours for our 7 fee earners. So in this case, 2 principals, some solicitors and legal support people. So there's 13,832 from those 7 full-time equivalents. Across all of those, they're expected to have an average target productivity of 49%. So remember, productivity is what's expected in terms of the amount of billable hours that you're putting in a day that you're there at the office full-time in that day. So that will be the average over a range. So in this particular firm, I'll just unhide this. Oh, I can't. I've locked it down. And in this particular firm, you'd have an expectations, maybe a 5.5 for solicitors. There might be a lower productivity expectation for principals and legal support people. But the average comes out at 49%. So what it's saying is out of these hours that we're paying of 13,832, we're expecting that 5,720 of those hours end up being added into WIP. Okay, so that's 49% of the hours that people are there at work, not the paid hours, but the hours that they're at work after you take out annual leave, sick leave, public holidays. So usually work on 44 weeks of the year. And then the average charge rate across all of those people is $388. So the expected value of time that you're supposed to be putting into WIP is $2.2 million. So importantly, and very important to understand, this average rate that we've got here, this is the capacity of the business. This is what we would expect the value of the at its baseline before we change anything. That is what we would expect, or the maximum amount of revenue we would expect to generate. So let's say we implemented a strategy to start with where we could get that productivity up to 45%. So we're still not at capacity of 49. We're only at 45. We're expecting that people will put in 5,720 hours, but we're only getting 5,267. Better than 4,598 where we are. And what we're also going to do, though, is we're going to increase our charge rates. so that our average charge rate increases. My experience is in most firms, charge rates are way too low. It's a bigger issue with you as solicitors rather than your clients. They already think you're expensive, so stop disappointing them. Put your charge rates up. So let's say we did that and we went to $440. What that does, that increases our amount of time that's actually entered into WIP from 1.956 million to 2.317. Doesn't mean it's actually billed yet, but we're focusing on systems and processes in the business around improvement of time entry. How do we do that? How do we manage our people so that they enter more time? I'll come back to that shortly and briefly. But we're generating more revenue because we're getting more hours and we're doing it at a higher rate, getting it into WIP. Then what we've got to do is we've got to bill it and get it out of WIP. So let's say we can improve our write-off, but we're not bringing it down to zero. Let's say we only got that down to 5%. So in this case, what that means is from the same work, and this is where I think a key thing is for people to remember, is the amount of money that you're leaving on the table in terms of your profitability and revenue is significant. And it's all to do with what your systems and processes are in your business and around how you position what you do with clients. Your clients, as I said, they already think you're expensive, so stop disappointing them. I expect that there is always at least a minimum of 20% improvement in in revenue that can be achieved by better engagement and then billing for the work that you're actually doing by getting better systems. But let's put that to one side. We've got improvements here in our average rate of 100 to 159 from 131. Now, really, really important, something for you to remember. That's only an increase of $28, but how did we get it? What we did is we got on average an improvement of only 26 minutes per day of being added into WIP. So it's not asking people to do more work, we just need them to capture it better. But only 26 in this particular example, only 26 minutes a day at a higher rate of next average $15 that comes out produces extra profit, extra revenue, and then we bill more of it. So we get this average rate. And again, this is just as an example, because in this firm, it's going to be different for every firm, but it fundamentally shows you how your average rate drives improvements in revenue. And then if we look at what impact that has in profit, we've got this extra profit, extra revenue coming through over here, same direct labour costs, same admin labour, same overheads, but our profit before principal salaries goes from 637 to 1,028,000. Now, you might look at and go, so yeah, it's just maths. But the reality is that the results that you're currently getting is a direct result of your systems and processes in your business that are producing behaviours that aren't complementary to predictable revenue and predictable outcomes. And that's because most firms allow discretion to dictate at the fee earner level around what they bill, what they don't do, what they work on, and they do not focus on their financial management systems. So first thing is get some structure around that. But going back to valuation here, we get a higher profit that's being generated in the business, and we maintain the same principal salaries. Then our EBIT goes from 287 to 678, purely because we're generating more revenue out of the work that we're currently doing, simply by capturing it better, simply by billing it better. And then if we even don't change up significantly any of our risk systems, we've got a value there that's increased for this business from 862 to over $2 million. So that's that first component. Whereas if you're driving your numbers in the business to produce better profitability from the work that you're currently doing, you don't need to find more work. There is significant profitability improvement just in the work that you're currently doing that you're leaving on the table. If you can capture that and just maintain your same earnings multiple, the value of your business has got to increase. But then let's go and say we also did some strategies in the business to improve our lockup days, so that our lockup percentage reduces. We've got our average rate increase down here from 131 to 159. But let's say we did some strategies that got our WIP build faster, so that we reduced the amount of WIP that we had, and we also collected our debtors better and faster, so that our revenue lockup percentage went from 33% to 22%. So what it does, it means for a higher value of revenue, a higher revenue amount, we actually carry less working capital. So we've got a business increase, our liabilities are the same, but our working capital has come down, which means we've got more of that profit in the bank. And have a look at this difference that we've got in goodwill here. So our goodwill has gone from 360 to $1.65 million. So you might look at that and go, oh, that's crazy. But that's the reality of how valuations work. Drive the profitability up in the business, making sure you're generating the right profit from the work that you're doing, from your clients that already think you're expensive, with minimal marketing efforts, because most of your work comes from existing clients, or from referrals from existing clients or your referral networks. Most firms have pretty average marketing activities that drive traffic into the doors. So your clients already made their decision they're going to buy from you before they come and see you. As I said, they think you're expensive, so stop disappointing them, and generate the profit you need to out of them. Get it billed faster, get it collected faster. Your clients sign a costs agreement that say this is how the terms of trade, but most systems in law firms don't align to those costs agreements, which means they have discretion around timing of billing and amount of billing, which then drives poor performance in working capital management, which then produces higher working capital asset values, which then has impacts on cash flow and drives value down. So change all of that up, and you can see the impact that small changes have in driving improvements in value of this goodwill. And our only changes here are get an extra 26 minutes a day, bill more of what's going into WIP, get some tighter systems so that billing happens more regularly and we collect our debtors faster. We're not taking our $600,000 of WIP down to zero. There's only a small reduction in that as a net dollar value, but the impact that it has on value, significant. So again, looking at that, looking at how those average rates and the revenue lockup percentage, by focusing on those two key numbers, can have significant impact on your value. But if we take that another step and say, right, we've got there's more strategies we can implement in the business to further reduce risk, so to further drive that earnings multiple up. It might be your sales strategies, your marketing strategies, looking at the amount of revenue that's generated by principals and the reliance on solicitors to generate more revenue. It might just be simply by getting really, really, really strong cash management systems in place that produce a better multiple. So let's just have a look at if we got an increase in that multiple, say to 3.5 times. Now again, our business value goes up, our goodwill will go up. Okay, so with that being the case, we're able to really focus on strategies that drive. So one, let's focus on getting our average rate up, more profitability. Two, let's focus on our revenue lockup percentage so that we're getting more of that profit into the bank account. And then three, what are our systems to drive even more improvements in both of those so that they're less reliant on the principals. So hopefully from that you can see that small changes in those key drivers can have a profound impact on valuation. So let's just go back here to, where am I? Let's just go back here and summarise that. looking at some actions that you can implement in your firm to increase your average rate. So the first thing is you've got to remove discretion. This is financial management number one. This is how we do it here. Take away the discretion of fee earners having any influence over what gets billed to clients and the timing of that amount and when. So fee earner engagement. Engage with your fee earners around their expectations. This is what's expected of you. You're 5 hours a day, you're 5.5 hours a day, you're 6 hours a day, whatever that might be, and here's your rate. Engage with them to make sure that they understand that and that they believe that it's doable. Usually it's just a habit that they're not putting their time in for work being done. Change the context around time entry. No billing happens at the time of time entry. You need to make sure that we're recording all of our time. Better client engagement. Focusing on really clearly articulating to clients at the front end, this is what our fee is. This is what we're estimating it's going to be. This is when we're going to be billing you. This is the timing of that. This is what we're going to do when it goes out of scope or there's more work. We're going to re-engage you. Get really clear on that, and then focus on workflow management. Focus on what matters people need to be working on. File velocity is the key. Shortening the period of time when a matter is open and in the business. The shorter that period of time drives improvements in those key KPIs of productivity and write-off. So getting people focusing on working on the right things. And then timesheets. Timesheets are an essential part. At the end of the day, you need to understand how much time is being spent on every single matter. Timesheets are not actually a measure of what you're going to be billing. It's a measure of how much time is spent, so you can determine whether or not you bill an amount. Whether you're a fixed fee business or not a fixed fee business, it doesn't matter. It all comes down to the same thing. We've got this labour cost that we're paying for. How much time is being spent by those people on that labour cost, so how much is being billed to the client. You need to be able to measure it. There's an old saying, what you can measure, you can manage. So you need to really be understanding your numbers. And then focusing on your billing processes, taking the discretion away from your fee earners to determine what amount is going to be billed. Billing is a finance function in any business, including a law firm. It's a function that must be managed by finance admin, not by the fee earners. Their job is to do legal work. Their job is to also re-engage clients when it's out of scope, but their job is to do legal work. They are not financial managers. So talking about some actions to reduce your revenue lockup percentage. Again, remove discretion. You've got to make sure that lawyers are only doing lawyer work. They're not doing financial work. So again, client engagement, including your trust account policy. Clients got to be absolutely clear on those expectations. Put this money into trust. This is when we're going to be billing you. These are the amount that we're going to, got to spend the time and really be clear with clients at the front end. And increase your estimates. As I said, your clients think you're expensive, so stop disappointing them. Make sure that your engagement is, and your estimates are priced right. Put it out there. Have a structured billing policy. That means that depending on the type of engagement, it's either billed monthly or it's billed at a stage or billed at the end, deferred. And then what you've got to do is you've got to build your systems so that it aligns that. So if a client signs a cost agreement that says we're going to bill you monthly, bill them monthly. Make sure that that happens because that's what the client's expecting. Apply a no write-off policy. So if it's in WIP, bill it. The amount of WIP is the amount of work done. Now, there's already time that's not going into WIP that isn't getting billed to clients because most firms struggle to get their productivity numbers. So if they're actually doing work, not putting it into WIP, and then you're writing some of that time off, you're just writing off bad debts even before the client gets a fee. So if it's in WIP, bill it. Create structure around that there cannot be a write-off of any WIP by any fee earner or anybody unless there's an approval by by the write-off champion, the person who is delegated to manage and make sure that write-offs aren't just happening. And then make sure you've got a dedicated person to collect your debtors so that they're constantly focusing every week on who's out of terms. So if your terms are 7 days, by the time you get to day 8, day 9, clients are being contacted. You got to pay us. And again, if clients continue to be out of terms, stop working. Make sure the client understands this as part of their engagement. You're expected to pay, put this money in trust, top trust up. And if you don't, we'll stop work until you get your affairs in order with us. So just some simple strategies there to reduce your revenue lockup. Okay, so that's it for today. Our next webinar is going to be on setting fee earner targets for next year, which we'll do next month. Quite a timely webinar, given that we've got 30 June just being around the corner. And we'll do that sort of mid-June. And in that webinar, well, I'll be giving you some insights into what I see that works and what doesn't work with firms. Particularly where you've got expectations that you're saying to people you need to do 5.5 hours, but you're then reducing their billings budgets. They can do the maths. So let me take you through that. We're going to talk about capacity. We're going to talk about fee budgets. We're going to talk about how you monitor that. So watch out for that invite for that next webinar. And as always with my webinars, the first 5 attendees to email me today, we can arrange a 45-minute online meeting, free of charge, no obligation, where we can discuss your average rate and your revenue lockup in your firm, so that you can pick my brains, use that time to start thinking about what your strategies are going to be over the next 12 months. So just send me an email to matt@fwaca.com.au. There'll be a little bit of data that we need you to provide to us, but nothing that's terribly onerous. And we'll schedule in a time and catch up. So again, thank you very much for your attendance at our webinar today. I hope that you've taken a couple of actions out of it. That you can implement in your business to drive the value of your law firm upwards. My name's Matt Schlyder from FWA Chartered Accountants. We're the lawyers' accountants. We'll see you next month.